to today's webinar. Today's webinar happens to be the third in the series of 4 parts looking at issues of problem loans. And today we are going to continue with the strategies for controlling and managing delinquency crisis. My name is Yao Jemfi. I'm the Executive Director for GAMFEN. And I bring to your attention that we have changed the date for one of the webinars, Proactive Strategies to Prevent Non-Performing Loans, from 1st June to 15th June. And the time will be 1 p.m., just as we do every time. Now, today's webinar is hosted by GAMFEN and Capital Plus through our partnership with MasterCard Foundation to strengthen GAMFEN's non-bank financial sector players. The program is called First Plus, which stands for Financial Institution Resilience and Strengthening. Now, First Plus addresses common challenges across the industry through webinars like this, workshops, and then training sessions. Capital Plus also provide one-on-one technical assistance to financially solid institutions that are committed to scaling up MSME financing. Today, at the end of the webinar, we'll provide you with contact information and then also share the video with you. Those that we've done already, all the videos are on GAMFEN's website. Just go on gamfen.org, look for CAPLAS, and then you'll see all the videos for the past webinars and then the current ones that we are doing. Today, we still have our 2 gentlemen with us, Mauna and then Ziblim. In fact, they need no introduction, but let me just give us a short background of what they've been doing with us. Mauna has had over 12 years experience in this industry, and he is a specialist, agri-finance specialist in agronomy, financial inclusion, MSME, and then agricultural finance, working in Ghana and globally for the past 12 years. He has worked with institutions like ProCredit, Fidelity Bank, Advanced Ghana, and currently work with IPC, a German financial sector consulting firm with as a senior agri expert. And he is based in Ghana with a firm. Ziblim has had over 15 years experience in both banking in Ghana and outside Ghana as well, and provide consulting services in credit risk management, credit restructuring, credit portfolio management, arrears and loan recovery management. He has led teams during periods of strong portfolio growth and then also during times of consolidation. As I said to you, this gentleman has gradually become part and parcel of our industry, and they lead this crucial topic for us. So today I have them with us, and as we usually do, let's keep all our questions intact, and then once they are done with the presentation, we'll ask them the questions. So gentlemen, you have the floor. Can we hear from you? Thank you very much.
So good afternoon, everyone.
Yeah, Mauna is Ziblim, you can go on.
All right, thank you very much. Ziblim.
Unable to share my video because I'm told the host has disabled it. So if the host can kindly enable me so that I can show my video. So to start with, basically today, we're going to continue from where we left, except that we're going to do this probably with another set of audience. Today, the main objective at the end of the section, what we want to achieve is to make sure that every participant is able to understand how to analyze factors that are affecting delinquency. Again, we want to identify incentive that we can give to our borrowers or clients to be able to ensure that they do a timely repayment of their loans. And again, we want to also develop strategy for keeping delinquency within acceptable limits, and look at the success of what we have to do to achieve those success and what we do not have to do if we want to achieve the success. Again, we want to be able to look at the techniques. So by techniques here, we want to look at how major delinquency problems are analyzed. And then we want to look at how to plan a comprehensive response to the delinquency. That is to say, in the short term or long term. And then we will look at the key success of this implementation. So basically, this is what we're going to start with today.
Thank you very much, Zibrim. So to begin with, we'll be looking at the strategies for controlling delinquency as indicated by Zibrim. We'll start by looking at the institutional factors, things that we do from our side as financial service providers. So we have categorized it into two, those things we do before and then the things we do after. So looking at the things we do before the loan is disbursed. In terms of client acquisition, what are our questioning skills? What kind of information are we able to get from the customers to be able to do our analysis of the loans? There are times where also internally, we have our own staff who build up financial information and bring businesses that don't exist. They bring financial analysis of business that don't exist to committee. To what extent are we able to check this to be able to cut down the possibility of fraud in our institutions? There are times where maybe because the officers are not well trained, they are not able to do proper analysis, both qualitatively and quantitatively. Most of the time, they will bring in numbers that look good, but behind the numbers, what are the information that we can gather from there as financial service providers? Then there are also times where the structuring of the loan is such that it doesn't fit the cash flow or the cash movements of the business. It is important for us to structure our loans such that it goes hand in hand with the way money moves in and out of the business. When we are giving out the money, is it going out at the time the customer needs money? When we are expecting repayment, are the repayments put at points in the lives of the customer where money is coming into his hands? So those are things we can look out before we go ahead to give out the money. Now, after disbursing the money, there could be times where you realize that you may have given too much money than the customer actually needed. It could be as a result of bad analysis or as a result of the customer maybe asking for more money than they actually need, because we know that sometimes when people apply for money, the financial institutions will cut it down. So some customers will come in, apply for an amount more than what they actually need, knowing that when you do analysis, you are going to cut it down. There may be times where you will not cut it down and then end up giving all that money to the customer. What are we going to do about this? It's possible that we can have a discussion with the customer to recall the funds, but if we don't have good relationship management with this customer, they may not be able to reveal this kind of information to us. So it's important for us to develop relationship with them so that they are comfortable enough to make this kind of confessions. There are also times where you may have given less than the customer actually needs. Sometimes they may have applied maybe for purchase of a machine. You pay for the machine, but don't make provisions for the installation of this machine. This is under financing. Once this is done that way, we realize the customer will not be able to complete the investment. And we know that the investment being made is the one that is going to generate revenue for us to make a repayment of our loans. So if the investment is not completed, what it also means is payment may not be able to be done on time. Then on top of this, there are times where we don't do proper monitoring after giving out the loans. When you give out the loan, it's important to follow up, one, to check that whatever has been applied for has been done according to the specifications. If it is maybe payment for birds to come to the farm, you follow up to go and check whether the birds have actually been received. So it's important to check to be sure that the investment plan has been achieved. Then there are times where the customer may have relocated from their business position. So if you don't make follow-ups, if you don't do monitoring, how would you be able to tell that this customer has moved? During monitoring, you can pick a lot of warning signs that can help you in making decisions on what to do about the loan. Zibrahim.
All right, thank you very much. So basically what we are saying is that if you want to get a strategy to control delinquency, it doesn't start from the time you disburse the loan. It has to start from day one, how you meet the client, the kind of interaction you have with the client, how well do you know the client and the client business. And that is a starting point. So if you want to control delinquency, ensure that you understand the client very well, you understand the business of the client, and then the needs of the client. That is how to start already to control your delinquency. Don't wait until you disburse the loan. Then that is when you want to look out for strategy of controlling delinquency. So one, we are looking at before the loan and then after the loan. So Mamina can move. Yes. How do you analyze the client factor? One, we want to look at the diversion of funds. Basically, understand the client well. You don't understand the need of the client. Like Marwana said, you are likely to overfinance the client. And if you overfinance the client, there are 2 options or 3 or more options available to the client. Either the client will use the money for other purposes, which is not known to the credit officer, or he will buy items which are not needed in the business. So at the end of the day, stock which is not moving, and the client will use their money to go and buy such a stock and put in the shop, what is going to happen is that nobody is buying. And if nobody is buying, of course, you cannot get the money to be able to pay your loan. So knowing the client is very, very important. Incomplete implementation of investment plan. One thing we don't do, if you want to control your delinquency, you need to ensure that when the client comes and tells you the loan purpose, for example, I'm buying stock. That is enough for some officers, but this is not enough if you want to manage your delinquency. You need to understand the type of stock this client is going to buy. It should give you an investment plan to tell you the price and then the item. You look at it critically and know exactly.
Zibrahim, can you take that section again? You went off a bit.
Okay, which one? The diversion. Hello, can you hear me? Hello?
We can hear you now.
Yes.
Great.
I think the investment plan.
The investment
Okay.
plan, if you can take it
Right.
again.
Okay, so a loan client comes to your banking hall and apply for a facility. Most of them will tell you, I want to increase my stock, or I want a working capital. This should not be enough to stand there. You need to probe further. What kind of stock is this person purchasing? And where is the person even purchasing the stock from? By this, the person would have told you, probably, I'm buying 2 sets of generators, I'm buying 15 bulbs of this. Have this list of what the client wants to buy, and then the rough estimate in terms of how much the person needs to buy them. At the end of the day, you can quantify it and be able to tell the exact money the client may need to be able to get the stock. Without this investment plan, and you just go by the word stock, a stock is a stock. 1 million Ghana cedis can buy stock. 50,000 Ghana cedis can buy stock. So which of the amount do you need to be able to give the client to buy the stock? The investment plan will guide you to be able to know exactly what you are buying from, you are giving the money to go and buy. Again, disaster. Before you disburse any loan, at least you need to make sure that you make some visibility studies. Pay a visit. Look at the environment in which the client operates. If, for example, somebody is operating in an environment like Circle in Ghana, we know there's a big gutter there. When it rains, most often than not, you get flooded. And then this shop is located around that environment. Of course, you need to know one day or in the next few months, if there's a rainstorm in the country, that area will be flooded. What are you going to do? So look at the environment, not just go and see the timing is okay. There's no rain season at that time. The business is doing well, so you give out the money. Forecast and see in the future what will happen in that kind of area. If it's a fire-prone area, earthquake area, or a flooding area, you need to already see this. So probably the time of the visit will not be at the time of the disaster, but look out for the future. What would happen in case of such a disaster? That is also one way to manage your delinquency. Again, we're looking at client-related issue. During your visit, you need to pay attention to the nature of the client. What kind of character is this person having? If you go to visit a client and realize that every time you book an appointment to go and meet him or her, the person has traveled somewhere. You ask where the person is going to, it's either he's gone for funeral, he's gone for some marriage in Tamale, or he's gone for any other social event which is not related to the business. The person doesn't have time for the business. It tells you that when you give out the money, definitely there's going to be an issue. So don't look out for the stock and how beautiful the shop is and give money. Look out for the management. That's why we're looking at the management style of the person. If the management is so much of traveling, of course, you know what is ahead of you. Again, poor business management. So that also boils back to this. In terms of cash bookkeeping and cash management, anytime you go there, you realize that the client is keeping so much money with him, when indeed the person could move to the next branch of yours to deposit the money, and is keeping the money. It tells you that this person is keeping so much. And anytime there is somebody who walk into the business and be able to steal this money or theft or anything, is going to have a big impact on your repayment. So look out for the management style of the person. Is he somebody who has time for the business? Is he somebody who really take care of the business and does not have to leave the business in the hands of somebody and all that? This will give you a fair idea where your money is going and how well your money will come back.
Okay, thank you very much, Zibrim. I think we just go on to the next. So it's also important for us to look out for what kind of incentives can we give to the customers, and what are some things we do that disincentivize our customers. So the first one is about the structuring of the loan. How have we structured our loans, especially when it comes to the repayment? Did we structure the loan to meet the structure of the customer's business? There are times where some businesses have irregular inflows. How did we structure our loans according to this? It's important to match our repayments with the cash flow of the business. Otherwise, if the business is such that there's a particular point in time in the year where cash flows are low and they need money, and it is that same time you are expecting repayment, you can guess what's going to happen. You rather use the money to do the business need than to come and make payment to you. So it's important for us to structure our loans to go with the cash flow needs of our customers. Now, when it comes to appraisal of loans and disbursement to our customers, it's important that we do this on time. Some of the business needs or some of the investment needs are time bound. For example, when you look at the agricultural sector, there is a window for planting between February to April. If a customer applies for a loan to do planting, it is important that you give the money to him before that window closes. Once you do this, he is able to plant according to schedule, and then the projections will work. If you delay the disbursement and it comes after the season, the window has closed, what it also means is there's a possibility that the crops will not develop as expected, and this can come back to haunt us. It's also important for us to understand the client. I think we mentioned this earlier. Understanding the client as well as the business that they are running and the environment around the business. It is only through this that we're able to tell what are the needs of this business. And for these needs that the business has, what financing opportunities do I have? And the financial opportunities, are they able to address the needs of this business? So it's important for us to understand the business. When it comes to repayment, we know that many of our customers may be illiterate. So they may not remember the dates that they are supposed to come and make their repayments. So it's also necessary for us to send text messages to serve as reminders to them. Also send messages to encourage them to make deposits ahead of time. And this can also help us with our recoveries. It's also important for us to organize sometimes business workshops, not just financial literacy classes for them. Organize business workshops, engage NGOs and co to educate the customers about the intricacies of their business, how to manage their business properly. In many cases, when we give our loans, the businesses want to expand. Does the customer have the capability to manage a bigger business than what they are currently running? It's important for us to build their capacity as we try to also finance them. When it's possible, it's also necessary to assign a dedicated relationship officer to our customers. In many institutions, these are loan officers. So they do the analysis and they make sure they follow up to ensure a continuous relationship between the customer and the institution. It is only through this that necessary information that could be warning signs can be picked up and then relayed to the bank for necessary decisions to be taken. Whilst doing this, it's also an opportunity to do cross-selling, sell other products and not just focus on loans. Sell other products like deposits, investments, other types of loans, help with convenience like internet banking. When you offer these kind of things to our customers, it makes life easier for us. They are able to make payments through other channels. The deposit that they would have built up, when a time comes where maybe the business is not generating enough revenue, this deposit we mobilize could also help to pay some installments. Yes, Zibrim.
Thank you. Let's move on.
Okay.
Right. So now we want to look at keys to success, what to do and what not to do. All right. So we basically said a lot already. Now let's look at the client acquisition. When we go for this client acquisition, mostly we go to sell our products and that ends it. We have a loan, we have a business loan, we have a housing loan, and we sell all the products. At the end of the day, the client comes to the bank and asks for a loan facility. We go to visit, and all we visit to do mostly is to go and look at the business and come back home or back to the office and work. Basically, referrals is very important. You need to seek reference. So if you visit a client, after visiting the client, you need to find a way legally acceptable to be able to ensure that indeed that business belongs to the client and what kind of business this person is doing around. You don't go to disclose any information to any third party. You need to find a very strategic way to be able to find out the reality of the client and then the business existence. There are instances where people walk into a shop and pretend the shop is for them. They arrange with the customers, the shop attendant, that I'm bringing somebody to come and inspect the shop. They will not tell the person it's coming from a bank. So they come and stand in the shop, pick some items, pick some books, receive some phone calls, and the credit officer will really walk in and believe that this shop belongs to this person, when indeed it's just a setup. If you seek reference from the people around, you'll be able to know the true identity of the person applying for the facility and if indeed the business belongs to the client or not. If you don't do this tomorrow, you realize that you have already been duped. The client has taken your money and it's gone. You go to the shop and they tell you we don't know the person, just because you did not seek for reference. When it comes to analysis, we need to pay attention to two areas. One, qualitative analysis, and two, quantitative analysis. Quantitative, we all know, basically the financials and all the figures. But the qualitative is very, very important. You need to look at your instinct, all right? The kind of things you see, the body language of the client. When you are moving to the client's place, the kind of calls this person is making. These are all issues you cannot get in the financial statement of the client. You need to see this from observation. So pay attention to the qualitative aspect of the client. Again, if you are able to do the analysis and you come to committee, that is banks that have committees. Some financial institutions don't have a credit committee. They have a line flow where Mr. A, credit officer, finish, he moves the file to the credit manager sign, and then branch manager sign. It's like unit people signing. But in the event where your bank operates a credit committee system, where people come together and make a decision on the facility, indeed, you need to get the right people to be at the credit committee. One, the credit committee members need to really ask questions, relevant questions to the business. Of course, members of the credit committee often than not are more experienced. So they need to be able to ask relevant questions. If there's a need for the credit officer to go back and do additional work, this must be done. If the case must be disbursed, okay, they can go ahead and approve if they have all evidence, satisfactory evidence to believe that the business is good. If there's anything to keep until further notice, the facility must be kept on hold until we get all the relevant information. And also remember, credit committee must not delay client loans unnecessarily. So we should look at the timing and ensure that we move fast to be able to get the right information and give out the loan at the right time, because disbursing loans at the wrong time also has its own issues, right? Then the disbursement. We need to pay attention, pay cognizance attention. Like we said earlier, you pay attention to your client, get to know your client, know the nature of the client business. If you are able to know this information, it is easier for you to structure the loan repayment. Sometimes we disburse the loans when the clients don't need the money. It's because we do not take the time to understand the business. All we know is that we visit the client today, next week we are finished with analysis, committee has decided we disburse. That is not how to disburse a loan. What is the client going to use the money for? And what time does the client want the money? If you finish analysis today and the client needs the money, let's say next week, and you delay 2 months time before you give the client money, obviously, you know what it means. You are giving the client money at the time he or she does not need such a money. So disbursements must be done accordingly. Some clients are also going to do, let's say, a fixed asset buying. You can pay the money directly to the vendor and get the item. You don't even hand over the money to the person, okay? And some people are going to do projects where month 1, he need X amount of money. Month 2, he need B amount of money. Don't give the client the entire money from day 1. Disburse the loans in tranches to ensure that the loan is used for the intended purpose and at the same time, the time the client needs such a money. I hope this is very clear. And then post-disbursement. In most cases, when we disburse the loan, we always don't want to go back and monitor, like Mawena said. But the investment client, the investment plan the client gives you is an enough monitoring scheme. If the person says, I'm going to buy goods in, let's say, Tamale, and when I send the money today, the STC or the bus or the truck bringing the goods will take 3 days to arrive. It means after you disburse the loan, don't follow a structured system where they say, okay, go and monitor the case 1 month after disbursement. It does not follow. Your investment plan, I told you, I'm buying the goods X amount from this country or from this region. Why will you wait for 1 month before you go and monitor this case? So look at the investment plan and when the money will be expected to buy whatever the client is buying, and visit the client at that time, not at a time when the committee probably who don't also understand the business tells you visit or monitor the case after 1 month or 2 months. And when you visit, please make sure you look at the investment plan. Is it achieved or it is not achieved? What do you expect if you put such amount of money, let's say in stock? Do you expect to see the stock to increase or the stock should reduce? Definitely it should increase. So if you visit and you don't see an increase, of course it means there's something wrong somewhere. Look out for that information quickly and act very smart. Again, develop relationship with what? Guarantors. Like we said earlier, not only the client pay your money, sometimes you need to get a very good moral guarantors to be able to support you. So one way to develop a good guarantor is to ensure that you have a very good rapport with the guarantor, knowing the kind of things you are doing with the client, because legally, once the person has provided you the guarantor, it means the guarantor knows everything about the loan. So if you discuss the loan issue with the guarantor, you are not disclosing third party or the client information to third party. It is allowed because he has legally accepted to take liability, and the guarantor must also know what he's liable for. So develop this relationship to be able to explain the liability nature to the guarantor so that if he's ready to accept it, he goes on to guarantee for the loan. Again, this guarantor will become somebody who will give you necessary information, because when the client start misbehaving and the guarantor knows he's liable, quickly he'll run to you. But if you don't have a good relationship with the guarantor and the client is mismanaging the business, the guarantor will not even call you. So this is the need, some of the needs why you need to develop a very good rapport or relationship with your guarantors. The bottom line is that don't focus so much on the quantitative. How much is your sales? How much is your cost of sales? How much is your expenses? You have your profit, then you look at the repayment. No, look out for the qualitative. They speak louder than the quantitative information we get from clients.
Speaking of qualitative and quantitative, there is this thing we usually say in our branches that is the person who pays the loan and not the business. So that's basically what Ibrahim has just talked about. And speaking again about our relationship with guarantors, in many cases, we only get to talk to our guarantors where the client is defaulting. It is advisable that right after disbursement of the loan, you call the guarantors and let them know, oh, your guy has come for the money. Once in a while, when the payment is done, you also call the guarantor and let them know your guy has made payment, so that when the time the default comes, they are also able to follow up and support you in recovering the loan. Now we started talking about monitoring. Now, what do we do during monitoring? The types of monitoring we have. Yes.
Let me just interject a bit. Just before you go on, somebody has just sent me a question in relation to digitization and monitoring. So quite recently, there are a lot of apps that they use in monitoring. And I'm asking myself, yes, it can help, but this is human interaction activity. And you are simply replacing it with digital processes. How effective can digitization support this process?
Okay. So the digitization can be a source of monitoring, but it's not meant to replace the physical one. For example, when it's time to monitor the implementation of an investment plan, the digital means cannot be used to do this. You have to go and see for yourself. But when it comes to an issue like looking at the daily indicators, clients who have paid, clients who have not paid, what's on my watch list, for these ones, digital means can be used to address it. So digitalization is not here to replace our physical engagement with customers. So yes, we can do digitization, but it's important to also do the physical monitoring of our customers. Okay.
Thank you. So please, you can continue.
All right. So checking of clients' accounts balances prior to installment date is important. This will help us to know whether the client is paying or not. If the balance is too low compared to the installment, it is time to make a phone call to the customer to let them know, oh, your payment is due next Monday. And I realized that there's not enough money in the account. Because one thing we seem to forget is, even though according to our analysis, customer is making X amount this month, it doesn't mean he's going to make that X amount in bulk. The money comes in and goes out. So it's necessary for them to build up towards our installments. So it's important to monitor these accounts and then follow up to make sure that they're able to build up towards the loan repayment. Then according to the monitoring schedule too, it's important for us to follow up to visit the customer. As Ibrahim said, in terms of committee, it's not just out of nothing that we ask for monitoring. So the decision makers will just say monitor once a month. That's not good enough. What are we going there to monitor? If loan has been disbursed, we are supposed to go there and check whether the action has been performed. We also have some milestones in the life cycle of the loan and also in the life cycle of the customer's business. So these are the times that we have to schedule our monitorings to meet. For example, if there is a moratorium, just before the next payment, it's important to fix some monitoring there so that you can follow up to make sure whatever you are expected to generate money for the next installment, it is on course. So it's important to schedule our monitoring according to specific milestones, either in the life of the business or in the life cycle of the loan itself. What are some issues of concern? You go to do your monitoring and realize the investment plan or the loan purpose has not been fulfilled. What do you do about it? Immediately, you follow up with the customer to find out why this has not been completed or why this has not been done. There are times where it makes sense that they didn't fulfill the loan purpose. For example, you have a loan customer who is into poultry. He has applied for money to buy wheat. And then once after disbursement is done, he goes on the market and there is this information about maize prices rising. That moment, he takes the decision to rather buy maize because the prices are rising, and then he comes back to you to ask for money to buy the wheat. In this case, yes, it is diversion, but this is good diversion because if he doesn't do this and buys the wheat according to loan purpose, what it means is the prices of maize will go up, and then it will cost him more to be able to feed the birds. So this time he's able to make a good decision by diverting the money into maize. It's important to also educate the clients on keeping their books, to keep record of their inflows, their expenditures, and how they manage their cash. So this will give them a good idea of how money comes in and out of their business. So when they are planning on paying installments, they're able to program it appropriately. It's also important to remind the customers of their obligations to you. Let them know the implications of paying their loans on time, the implications of paying their loans late. So it's important for you to educate them on this as well. And finally, observe the changes in their business. You give him a loan, you expect stock to increase. You visit, you realize stock is rather reducing. What is going on? It's important for you to check to make sure things are going according to the expectations of the business?
Oh, that's great. So basically, what we are saying is that we need to be proactive. As a credit officer, as an analyst, as a business relationship officer, we all need to be proactive. That is the one solution in solving a delinquency. You don't wait for too long and keep smart, right? So part of the issues of concern, like my colleague just mentioned, is what assess the business impact. You give out money, like I said in the last slide, and you don't just give out money because the business must be the same. You give out money because you want to expect a growth in the business. So if you go to do monitoring, and like we said earlier, and you don't see the impact of the loan into the business, then obviously there's some level of issue you need to pay attention to. Again, it boils back to the proactiveness. Some officers go and do this visit without even noticing anything. They only pass by and say, oh, or something. How are you? How is the business? Once the client responds, good. They are also as good as anything. They move away. We don't want this kind of monitoring. You need to pay attention to the details during your visits. Okay. And again, when you disburse a loan, of course, we do appreciate the fact that we need to do a lot of quality loans. That is not to say one or two of your loans might not go bad. But the loan going bad in its effect does not necessarily mean things are too bad for you. Okay, so don't be afraid of arrears. Ensure that you do the right thing, do good work, disburse quality loans, and ensure you produce growth for your bank. But when one or two goes off, don't be afraid. Don't panic. You need to look out for strategy to be able to manage such a loan. So have confidence in solving arrears. Arrears is not a panic situation and you start running around, you don't know what to do. You even lose focus of your analysis because somebody is in arrears. No, have the confidence. It's part of the work. Arrears is supposed to come. However, we want minimal. If you do 100%, at least get 95 or 98% correct. If 2 or 3% is going bad, develop the confidence to be able to resolve and solve the problem immediately. All right. And during visits, when a client is in arrears, don't go and apply the same principle of arrears management to all the clients. Try to understand the nature of the arrears situation of the client. Some of the clients, they are just not willing to pay you. Others are willing, but they don't have the capacity. So you should be able to distinguish between these clients and apply the appropriate means of recovery in this client. All right. And then decide and act fast. For example, if you realize that you went to visit a client and the client is willing, he's been making some little deposit in your account, only that it does not meet the installment amount per month or per week or per quarter. It tells you that the client is making an effort. Definitely he's willing to pay you, only that the capacity is low. So this is not a client you should go and start giving him demand notices and warning him and confiscating his collateral. No, this is a client you need to sit with and understand why the problem is existing and come out with a strategy to ensure that this client bounce back to do business. So don't apply this same principle to another client where you realize that there is nothing to do apart from confiscation. Of course, you need to go and confiscate, sell, and then recover your money. So different approach of recovery to a different type of client, okay? Assume the image of a strict but a fair partner. Like I said earlier, when you go to visit the this is not time for sympathy. You don't sympathize with clients. We may empathize at a point, but at least keep firm. If you make a decision, you need to pay this amount of money because you restructured your facility and we expect you to make such volume of sales and we expect you to make such deposit on daily basis. Make sure the client is doing that. He should adhere to that agreement. Don't go and sit and think, oh, today is just not a good day. Please, no, we don't have anything like that in credit or recovery. Make sure that every decision we do with the client adheres to it and make sure he does it properly. Okay. And then, like we said again, any bad thing that happens in the credit, see it as a learning curve. All right. Of course, you make some mistakes. When you make the mistake, did you go to sleep or you look out for solution? If you are able to find a solution to the mistake, it means next time you might not repeat the same mistake again. Or in the event that another such similar mistake occurs, you already have the experience to be able to resolve it. So see recovery or arrears management as a learning curve. Don't get scared, don't panic or anything, okay? And when you do this, please react with that delay. Effective arrears management. Don't go and see the client business going down. Stock was 20 million when you visited. You give her money, it moved to 25. Next minute you go for monitoring, it's 50 million. And then you think like, oh, maybe there's some stock coming. Let me expect it. No, move fast to see where is the stock? When is it coming? Get evidence to see that the client are paid, and then he's expecting that stock to come. If you keep quiet and just do expectation, by the time you open your eyes, the business would have run down to zero. So ensure that you act fast. Go to the committee. Ensure that you organize a committee, narrate the issue, and get solution. And when you get the solution, discuss with the client and get the client to buy in and be able to ensure that the client understand why you are doing what you are doing, okay? And get the money paid back early. And then influence the quality of your risk management, all right? I mean, when you're doing this whole analysis, okay, there's a portion where you're on your own, you need to understand the risk and then the mitigation of such businesses. You don't need anybody to kind of tell you what to do. Like we said, the qualitative committee does not visit the client. So committee does know that when you were going, the client was hiding to pick a call. Committee doesn't know this. So if you don't inform committee, the credit committee, I mean, that when I was going on the loan visit, I realized that the client was not comfortable. I feel like financial institutions are calling him on low repayment. So he doesn't want me to know. So he's hiding to pick calls. This is a risk and red flag. The committee would have said, okay, why don't you run an XDS data to see if the client owes another financial institutions or not? Or do ABCD for us to get more reference, you know, a recommendation that will solve the future problem. So you are the own risk manager. As much as you are the credit officer, you are also a credit risk manager. You need to be able to come up with the risk you've identified during the visit to ensure that tomorrow or in the future, the client does not give you unnecessary problems.
Now, what are some techniques we can use in managing delinquency? When you have a major delinquency problem at your branch, at your institution, what are the things you are supposed to do? The most important thing is to do a comprehensive analysis of your portfolio. You do this by doing a visit individually to customers to discuss what are the issues, what are the reasons why they are defaulting. You conduct appraisal of these businesses to establish what is the current situation of these businesses that are in default. What are the key gaps? What did we miss in our
if you
analysis?
can repeat that, you went off a bit.
Oh, okay. So I was talking about how we do an analysis when there is a major delinquency crisis in an institution, in a branch, or even in the portfolio of an officer. It's important to do a comprehensive analysis of the whole portfolio to try to understand what is going on individually in the lives of the people who are defaulting. You do a visit to discuss what the current situation of the individual customers are and what are the reasons why they are defaulting. It's important to conduct an appraisal, just the way you do the appraisal during the initial loan application, to establish what is the current financial position of this business. It's important to do this type of analysis. Whilst doing this, we're able to identify what are the gaps, what did we miss in our last analysis, so we can correct them for the next phase of the loan. Whatever you find out, you discuss the feedback with the customer so that you can see what is the possible way out of this. Once you discuss this with the customer, you can then get his buy-in. He agrees with you on how you'll be able to resolve this thing going forward. And whatever plan you've decided on, you take action immediately. Set timelines for what you are going to do when. If it is about planning to have maybe manual payments over a period of time, maybe currently the customer is expected to do monthly payments, but I've realized he's not able to manage his cash well to bring all the installments at the end of that month. So maybe you renegotiate with him to make maybe a weekly payment towards achieving the monthly payment goals. Now, it's also important when you're doing this analysis to be able to distinguish which customers are not paying because they don't want to, which customers are not paying because they don't have the capacity to pay. This point is so important that I want to dwell on this a little bit more. Now, it's important for us to do a classification after doing this portfolio analysis to determine these customers that are in arrears, there may be some who have the capacity to pay and are also willing to pay. But maybe a small issue has taken place. It could also just be maybe during the loan analysis, we agreed that the customer is going to be paid for certain contract he has done at a particular point in time. Maybe payment will be happening 15th of every month. But after implementation, they realize that the contracting firm, the person who is going to be paid them, is rather paying them maybe 20th of the month. So you realize every month the customer delays by 1 week, What we can do is, this customer, he has the ability to pay. The only problem is there is a delay in receiving funds. So for such a customer, we can quickly reschedule his loan so that he can come back to regular status of his loan. There are times where you just have to restructure. You may have to top up a little bit. Maybe his working capital may have gone down a little bit. So you just top up and then he comes back to normal. You can also have manual cash repayment agreements with them. So these are the ways we can handle customers who have the ability to pay and are also willing to pay, but because of small issues, they are having challenges. Then the next category we can also talk about is those who don't have the capacity, but they are willing. Usually they are very cooperative. So how do we handle customers like this? Sometimes you apply some little pressure, you follow up on the guarantors to check on these customers to see if maybe the guarantors can maybe raise some funds to support in the repayment. Sometimes you also have to do negotiation with these customers. They may have something else somewhere, maybe there is a plot of land somewhere that they can also sell to offset part of the loan so that you can restructure for them. You can also discuss with them to take some of the collateral to pay off part of the loan, because the problem is the capacity is not there. They are cooperative and they are most likely to support in finding other ways of resolving the arrears. There are also those customers who are able, but they are not willing. This is a character problem. What do we do about these guys? The ideal thing is to end the relationship, but sometimes maybe the collateral you have is not enough. So what do? Sometimes we offer to do restructuring for them. There, you are able to get them to think you are on their side. So what they are able to do is, when you are restructuring, your intention is to try to add additional collateral so that if a day comes and he defaults again, you have more security to be able to pay off this loan. Then we have the category who are unable to pay. That means they don't have the capacity and they are also not willing to cooperate. Now, for this category of customers, this is where it is most difficult. They are the ones that stay longer in the portfolio. So the kind of things we can do with them is where we set a limit as an institution. Maybe from loan amounts below X amount is not worth going to court over. So for those ones, we just have to write it off. We also have to apply pressure. There are times where you can even wear your bank attire, go and visit them at their church. Just go and sit in the front row. When you're having conversations with people in the church, these guys will be thinking, is he talking about my loan to them? Apply this kind of pressure. Go to their neighborhoods regularly. Let them see your presence. Let them see that you are serious about getting this money. Sometimes this could work. You can also do periodic checks to see that he claims the business is down. You go and see the business is actually down. But it doesn't mean you should stop going there. Once in a while pass by, you'll be surprised to see that things have normalized and he's still not paying. In such situations, you're able to get your money back. If all things fails, you can write off, seize collateral, and initiate legal procedures for recovery. Ibrahim.
Right. So basically, we go back to the same language. We just have to be proactive, or we need to be proactive. That is the only way to manage your delinquency. Okay, so now we'll look at some of the arrears committee in organizing arrears committee, we need to ensure that we follow all the arrears management procedures. So for example, if a client, this is not in isolation, apart from being proactive, at least we need to follow the procedures as well. If a client defaults for a day or a week, if we are supposed to send him a warning letter per arrears committee or per the policy of the credit committee, of course we need to do that. So being proactive does not mean don't follow the procedures of your bank. You need to merge the two together, and that is what we mean by being proactive. You look at what to do, act fast and everything, and at the same time, ensure you follow the process and procedures. Legally, you could be protected when the issues get to the law courts. If you don't follow the procedures, you did not give the person a demand notice, no warning letter, no discussion, no nothing, and you go to do confiscation, you might not be spared when it gets to court. So follow the procedures and the guidelines of your bank, all right? Then at any point in time, you do such a thing, make sure you document it. For example, if the client is in default for 3 days and you visited and you had a discussion with the client on the way forward or the cause of the delinquency, when you come back to the office, you don't keep this in your head. Pick up your arrears committee forms, complete it, and report the action plan and the discussion you have with the client. And based on that, if the committee says go and give the client a demand notice or a warning letter, of course, you may have a legal department that will do some of these issues for you. However, if you issue the demand letter to the client, try to keep a copy on file, all right, to ensure that whatever transactions you are doing with the client is not in isolation. You do it part of the client knowing, and then the bank also know what you are doing. You don't go and take any decisions alone and come and sit down. Whatever decisions, whatever agreement you have with the client, ensure that this is documented and kept on the file of the client, okay? Again, like we are saying, now we want to ensure that we develop a very good relationship with our clients. We do not want to lose our clients. Financial institutions are becoming bigger and bigger, and more clients are moving from one bank to the other, all because of some of the way we treat them. Now it is more of the customer approach. Ensure that yes, we go firm, we go strict, but we need to act fast to also save the client. Because the more we react to go and seize collateral and sell, the more we sack most of our clients, all right? So we need to know the problem first. Don't go confiscation first. The first thing is to identify the problem. So if you get to know the problem, of course, you'll be able to know what to do, all right? If the client is struggling, the business is good, but he's struggling with repayment, probably seasonality. Things are not working well for the client at this season, but he has the goods to sell. There's the good management structure. There's everything in the going concern for this business. Why do you go and confiscate? Why don't you look at options of restructuring to ensure this person does not pay a higher amount, probably during the lean season, and ensure that he's paying good amount when the business bounce back? So restructure for the client rather than confiscation, okay? And if you don't understand the business, you will not be able to do this, all right? So restructuring could be an option based on what you find out on the ground. Again, if the client does not want to pay, everything is showing that he's not ready to buy by any of the things you've agreed with him. You did negotiations with him, it failed. You did everything possible to ensure that this client bounce back, and it's not. Of course, then you need to move to the recovery, which is issue the demand notice, the warning letters, confiscate, and sell and offset your balance. But if the client is not difficult and you negotiate with him and he agrees with the terms and conditions, look out for the solution to ensure the person is able to pay, okay? Sometimes you may want to even waive some of the interest just to guide the client to be able to pay. Probably there's so much accumulated interest and penalties on the facility. He has not been paying for the past 6 months because there was probably a disaster. Now he's got himself back and he's struggling to pay. And you have about 6 months penalty on the money. And the person is always paying only penalties and nothing is coming out. The principal is the same, interest is the same. Every money he deposits only goes to offset penalties, when indeed it was not the fault of the client. You may consider waiver of penalty. Waive it for the client. He will feel comfortable. He will feel excited. He will feel you know the needs of him, and you have an information about what he's going through. This person will have his loyalty with you to pay the money. If you don't understand, you cannot do all this I'm saying, all right? Sometimes you make the client also pay some of the money. Okay, the business is down, but at least you are making X sales. Meanwhile, you are supposed to pay X plus 1. Okay, you pay the X sales. You have a bicycle or you have a car which you use as a collateral. Discuss with the client. Why don't we sell the collateral and reduce your principal so that you can have it easy to pay the remaining balance? Okay, so pay partial, we sell the collateral partial and offset the loan. It is another argument you can bring. It all depends on how you approach the client and how you treat the client. If you don't do a good approach, the client will never understand to tell you, sell my collateral. But if you do a good relationship banking, the client will give you the go ahead. Okay, I can understand. You're also in stress. Okay, sell this part of my property, offset it, and let's move on. Again, at a point in time, there's nothing you can do. The loan has traveled more than enough. And then per policy, you are supposed to write off. Go ahead and write off the facility. But if you write off the facility, it is not the end of recovery. Every facility you write off, make sure you pursue to ensure that the client actually pays back the money if there is that need. All right. Okay. Sometimes also, when you visit this client, you realize that he is struggling. Meanwhile, he has more properties. Probably he took your loan for business. When he used the money for the business, he made some good sales, or he used part of the loan into the business. He used part of the loan to go and buy assets. Of course, he cannot pay the installment you give him. Now you realize that, oh, the money I gave him, maybe you gave him 20,000 Ghana cedis. He only used 10,000 for business. 10,000 was used to buy a piece of land, which is not in your name. Right now, you go to discover that he diverted the money there. Don't shake. Make sure you increase your collateral level. Let him pledge that land, which you use the 10,000, okay, in the name of the bank, so that in the event of recovery, you have more than enough security. If you don't do this and there's recovery, you cannot touch the land he used your money to buy. So relationship banking, get to know what the money has been used for. If it's an asset, increase your collateral level. Let him pledge it as part of the collateral and link that collateral to the loan and make sure legally you are covered. Get the documents, all right? And then when there's a recovery process, go for the land, sell it, and offset your loan. Create a comprehensive monitoring scheme and adhere to it. Of course, like we've always been saying, one area where most of our loans go bad is because we do not do proactive monitoring. We follow structured monitoring, 2 months, 3 months, or quarterly. This will never help you as a financial institution to get your money paid. Proactive monitoring means monitor timely when there is a need, and then you have to get a focus on why you need to do the monitoring and when you have to do the monitoring. That is more relevant than a structured monthly or quarterly monitoring scheme we follow. Thank you.
What are some of the implications of having bad loans? So we're looking at now the effect of the bad loans on our lending. One, we lose income. The revenue we're expecting from interest payment is not going to come when the bad loans are bad. And this can impact on our liquidity positions. It's only when we have this money that we can create new loans. But because the loan has not been paid, we don't have enough funds to lend on to other customers. There is also this opportunity cost of the institution. This money could easily have been used maybe to do investment in fixed in treasury bills, but we're giving it out as a loan. If the loan is not repaid, then we are losing that potential that would have gotten by investing it elsewhere. And once our loans are bad, you realize productivity reduces. The loan officer will have to spend more time chasing bad loans rather than spending the time to go for new loans. So realize the number of disbursements he can do to increase our profitability, that also goes down. So these are some of the things that bad loans can do to us. When the bad loan is bad, it means you also have to do provisioning. And provisioning, again, goes back to affect our profitability. So bad debts or bad loans really, really give us problems. Now, there is also the possibility that this can affect other things in our portfolios. One, if your loans are bad, you don't follow up to recover. Maybe it's written off and then you forget about it. What it could mean is other customers can be informed by this customer, oh, for these people, if you don't pay, just wait 3 months, 4 months later, they'll forget about you. Then this can start causing other people to also default, show the same attitude, and get away with it. It could also have an impact on the loan officer's portfolio as well in other ways. For example, when he has a number of bad loans, he focuses on trying to recover. However, he also has a target to meet. So he tries to meet this target as well in terms of disbursement. He may end up compromising on quality. And what's going to happen? More loans will start going into arrears. So you realize a particular loan officer starts getting arrears and it just keeps growing and growing and growing. This is the domino effect. the frustration that he's going through to try to recover loans affect his ability to think objectively in meeting his other targets. So realize his portfolio just keep deteriorating and deteriorating. It gets to a point where the institution will just have to stop him. You know what? Stop disbursement, focus on arrears only. So these are some things that having bad loans can cause for our portfolios. Ibrahim, you want to add something to this? Okay. Yeah. I think we have finished with the presentation itself, so maybe we can open the floor for questions. Yeah.
Okay. I think my first question will come from Clement. Clement, your hand is up. You can ask your question now. Sammy, do you want to unmute the person who wants to talk now? Clement Anafi.
Okay, Sam. Hello.
Yes, Anafi, you can hear you.
Yes, sir. Sir, my question is, with the current situation that we find ourselves, we are unable to transfer the ownership of properties. First, for instance, if you have a car as a collateral, you were able to do the transfer, the official transfer, so that the company will now be owned by both. The collateral will then be owned by both the owner, the original owner, and the institution that is lending, that is giving money. So with the current directive from the BOG, that collateral ownership shouldn't be transferred or co-owned by the institution and the client. He made a point that at a point in time, even if you are not comfortable with the way the loan is progressing, and you think the person is having more collateral, you are supposed to then bring in more collateral. You are supposed to then take ownership of some of the collateral so that you reduce the risk. How do we balance the two? I don't know whether my question is clear.
I think so. Yeah. Hello, Mauna.
Hello.
Yes.
Yes.
Did you get the guy's question?
If I got a question where I think he's talking about the Bank of Ghana's directive not to register collaterals in our names, and rather, yes, not to co-register the collaterals in our name. He wants to know what would be the case if we are talking about increasing our collaterals. So here brings us to the question of relationship management. The kind of engagement we have with our customers is what will make us be able to recover collaterals from them when the time comes. Zibri mentioned earlier that you have to assume the position of a fair but firm partner. In our relationship with our customers, I don't know how it is done in some institutions. It is treated as just for transactional purposes. I give you money, you pay back, nothing in between. It is important to keep relationship with these customers, become their friends. Just that when it comes to loan repayments, you let them know, look, this money that you have is not my money, it's for the institution. So they understand that, yes, they are your friends, but the loan has to be paid. So when situations like this come where you have taken collaterals, you have not registered it in your name, and it's time for repayment, and the customer does not have the capacity to pay, here you can easily negotiate with this customer, let them understand that, yes, if you pay this loan this way, you adhere to our agreement for repayment, we are able to give you another loan in the future. Because there are times where clients are afraid that if they don't pay, once they are in arrears, you are never going to give them loans in the future again. So they don't want to even cooperate and then pay again. But if they understand that, look, yes, I'm in a bad situation right now. If I get out of this situation, my friend, who is the officer here, will help me come back on my feet. And let's keep to our words. If we make a promise, we should be able to keep those promises. It is only by developing this kind of trust that when you have this kind of negotiation for our customers, they're able to cooperate with us and even offer us other alternatives. There may even be the case where he has another property which was not even pledged as collateral, but based on the relationship we have with them, he will even volunteer, you know what, I have this plot here, let me sell it to offset the loan. The current problem I'm having is temporal, let me offset this loan, then we can re-engage again. So it is very possible. Thank you. Hello, yeah, you are muted. So in case you are talking, I can't hear. Can anyone hear me?
Yes,
Okay.
I can hear you.
All right.
Yes.
Okay.
So basically, back to the issue of the collateral, like we were saying earlier on, issues of legalities, the bank legal department to be able to pursue. In any case, collaterals, or we are not doing collateral lending in any financial institution, it's a backup in the event of worst case scenario, then the collateral could be used. So definitely Bank of Ghana directive is to ensure that we do not sit to think we could collateralize all our loans just because we want the client to default and go for them. But the relationship we built with them, coupled with the kind of document the legal department signs with the client, it will give us an upper hand to go to court and be able to take possession of some of these collaterals.
Great. I'm going to step in because Yao's lost his internet connection. So Seraphine, would you like to ask your question? You'll have to take yourself off. There you go. Take yourself off of mute.
I think I'm okay now. I'm okay. Thank you.
Okay. And Seraphine, do you want to ask your question?
Yes, please.
We're not hearing you.
Please, the one asking the question, we cannot hear your question. If probably you're on mute, try to take off and then be able to speak so we can hear you.
Okay, since we're not hearing Martin, feel free to ask your question now.
Okay, thank you so much. My question is, please, can you hear me?
Yes,
Yes.
we can.
Okay, my question is a concern with one of the recent, one of the recent instructions that the regulator BOG has issued to all financial institutions is regard with we not transferring vehicles used as collateral. That is rather just take the document and the client can use it. My issue is this: in this country, if a client comes to leave his car document with you,
20%
that is using it for collateral, and this client defaults, and the last resort is to take the car, it is possible that this client could just go to the police station, report that his document is missing. He'll get a police report, an extract, take it to the DVLA, and the certified true copy will be given to the client, and you'll be holding documents thinking that your collateral is secure, but it's not secure. If BOG and DVLA can integrate their system so that if somebody comes to report of missing documents, you can just check to be sure if maybe that said vehicle has been used as collateral before it is done or it's refused, I think it will help all of us. In as much as we are not doing collateral lending, you and I know that in this country, trust is an issue with most of our clients. Yes, Marina has made a very great submission, Ziblim and Co. You should build a relationship with them, but believe you me, if you're on a field, it doesn't work. That's the truth. You build relations, it's just a few who will come out and then open up to you, but the rest will take it for granted. That is the fact. So if that's
Okay.
yes,
Okay,
so
Martin.
that is my
Okay.
yeah.
Yeah,
Martin,
Martin,
well
thank
noted.
you.
Thank you.
Thank you. So, Martin, this is something that you have to write officially to your association, so that we take it up as part of the advocacy thing that we do with Bank of Ghana. Because
Okay.
honestly, reporting it on this platform will not solve the problem. But if you report through the association, Gamfin can take it up and then work through with the central bank.
All right.
Yeah,
So Martin,
yeah, I know you are
again,
here. That's why I'm bringing it up. I know you are here. That's why I'm bringing it up.
Yeah. Thank
again,
you.
I think sometimes we can also manage some of these issues even before the association picks it up. You can also have a relationship with DVLA. So all clients that have taken facility and use such vehicles, documents you are holding, you could do a copy, discuss with your legal department, you could write a letter and submit it to DVLA. That's this client had taken a facility, and for now, it's in the possession of the two parties, though not transferred. So until the loan is repaid, the client might not be able to go to DVLA and take another copy. You understand? We should find a way before the association is able to talk and get some of issues resolved, because Bank of Ghana will take a long time for you to get some of these issues resolved.
It's been well noted. I get your point, but you see, on the ground, sometimes you receive some car documents, and if you look at the document, you know that it's been played with. People have paid their way through. As Yao said, this is not the platform to discuss it, but I think they should look at it for us, but it will not help
All
us.
right.
So, yes.
Okay.
Thank you.
Thank you. Nasiru, if you can ask your question now.
Yeah, good afternoon.
Good afternoon, sir.
Yeah, I think before I even come to my proper question, on the issue of the collateral, I even thought that when you were doing the presentation on means of monitoring, you see, we take the collaterals, we go to sleep, and the only time we visit the collateral is when the loan goes bad. There should be a system whereby we should have a collateral audit, whereby every 3 months, you go to assess that collateral and see even if it is there or it is in a very better condition. Now, my question on the earlier one, you made mention of looking at leadership style before advancing loan facilities. Later, you also came to make a point that once the loan delays, especially when it comes to agri financing, the season may be gone and the loan will not be that needed. So the possibility of it going back to is also there. But when you look at most of the banks, loan disbursement has a time limit. So what time do you think is conducive for the relationship manager or officer to be able to study that leadership style before even disbursing the loan, and it will not also affect the customer? Thank you.
Okay. So here we are talking about pre-disbursement assessment when you do your visit to collect information to process the loan. Now, during this process, it is also where you are doing your qualitative analysis. So analysis of a loan is not just limited to the numbers. When you visit the customer, there are questions you ask this customer that will get you to understand their level of experience, their expertise in the line of business that they are in. So this is where we talk about the questioning skills. What kind of questions do you ask during loan analysis? When you get to the business, ideally, you want to go through what does this customer do? For any type of customer at all, whether a Greek or regular trade, you want to go through what do they do? What's their business about? So they walk you through the whole business cycle. So if it's a farmer, I do planting at this time, I do harvesting at this time, I do weeding at this time, I do fertilizer application at this time. You walk through all of this. Sometimes when you're asking these questions, you get to know, like, oh, this guy doesn't even know what he's doing. Here, you're able to detect this is not an experienced farmer. So what's the solution for this? You check, does he have competent managers supporting him to manage his farm? If not, so the customer himself doesn't have the expertise, he doesn't have people to run the business, you want to stay away from a customer like this. If it's a regular trade, you walk him through. What did you start this? So in our customer analysis, we have to go through the whole process. So start from even the history of the business. How did he start this business? Some people may have inherited the business, and since the time they inherited, nothing has changed in the business. What does this tell you about the customer? So these are things we can do during the customer analysis or during the business analysis to establish the competence of the owner of the business or the person managing the business before we can proceed to go do disbursement. So we don't have to wait till maybe it's time for him to do something, then he shows up at the branch, I want money for this. No. If he wants money for something, it's not at the time the thing is needed that he would think about it. This already tells you about the kind of person you are dealing with. It's important for them to plan ahead. In planning ahead, what have they even made some savings towards the investment plan implementation? You cannot just wake up in the morning and come to the bank and say, oh, I need a car for my business. How much have you saved towards it? Nothing. No. So you see this kind of signs that this guy actually wants to do this. He has saved maybe 30% and he needs a top up from the bank or the financial institution to top it up. So these are some of the things you can do when you're doing the character analysis. Thank you. I hope I've answered your question.
Thank you.
Not really, because I appreciate all the explanation you gave, but considering the industry we find ourselves, what do you think should be the convenient time to do this assessment, even if the person comes on time that you think that the person should be coming at that time? What should be the convenient timelines?
Okay, so first of all, I wouldn't want to give straight jacket rules about this is the time you should do this. But ideally, taking the agricultural sector, for example, we know planting season is between March and April. So you receive applications for this earlier than this. So somewhere maybe between December and January, you would have made your reaching out. So sometimes you don't want to wait for customers to come and apply. You want to reach out to them. You know he's into farming. You know in February or March, he's going to need money to do this. So you go ahead of time and start this process to do the analysis before the need for the money actually arrives. But if you wait for him to show up before we start this analysis, then we may be under pressure to maybe give out the loan before putting certain things into consideration. So to give you a straight jacket answer, I cannot give you that, but let's do it way ahead of time so that by the time we are disbursing, we're also within time so that we don't have untimely disbursement of our loans.
Yes, sir. But beyond the agri example, I think most of the institutions don't do agri financing. Can you attempt an example with an SME?
Yes. So here also it's the same situation. We know the seasonality of the customers. Yes, it's not just agri that has seasonality. If the customer, for example, is into imports, and we know that the Chinese holidays comes at a particular point in time. So for such customers, you want to start the analysis, they have the money to send for the goods before this holiday comes. So it's always about doing it proactively, taking the steps before the need actually arises. This is why we keep talking about relationship management. So you understand the cycle of your customer's business, you're able to plan ahead of time so that you can start working on their request before the actual time. So you don't wait and then do emergency treatments. If you do emergency treatments, chances are that you may have to overlook certain risk factors, or you are pushed to do delayed disbursement, and this can have an impact on the quality of the loan.
Thank you. Now somebody has asked a question on, he wants to know the difference between the functions of a recovery officer and a credit officer.
Okay. So typically the loan officer is, or the credit officer, as we normally call it in this industry, is the person who does analysis of the loans and then progresses to disburse. Sometimes in some institutions, it's also required when loans default up to a certain point to follow up to recover. In some institutions, it could be up to 30 days. So the loan officer or the credit officer is responsible from application all the way up to maybe 30 days in arrears. Beyond this time, due to the need for efficiency, some institutions will say, you know what, loan officer, you are no longer responsible for the loan beyond this point. So then they have a recovery officer who picks it from that point. Some institutions have this, others may not have it. But functionally, the recovery officer is purely responsible for retrieving the loans after they've gone bad. The loan officer is mainly responsible for the active loans, loans that are current. Thank you.
Okay.
Thank you. Any further questions? Desmond. Desmond has something in the chat box.
Could it be where we talk about loans going bad? Basically, we are just talking about the loan being going into default.
Yeah.
So when the payment date is due and passed, then we say the loan has gone bad. So if that's what you're asking, then yes, that's our response.
Good. Do you have any more questions?
My last question was.
Okay, please go ahead.
Yes, sir. And now, boss, regarding the willingness of the client to pay the loan, I think there are a lot of factors, as you made mention of. When you visit the client, the kind of signs that you are supposed to pick and all that. But one of the things that do also really help us is the credit reference bureau. Now, from where you are seated, do you think the bureau is really robust enough for us to rely upon?
Okay. Basically, if you study the credit reference bureaus, the kind of reporting or the reports they give us, we have two sides of it. One, if you go to the commercial banks, for example, now some of them don't even report on the credit bureau because that is an area where other banks go to see clients and see that they are clean, and then they poach them. Okay, so if you want to rely on the credit reference bureau, you might not get the accurate kind of information you are looking for. You might realize that somebody has an exposure of up to even 500,000 Ghana cedis, and there is no single report of such a client in the credit reference bureau. So yes, it is more of an addition to you, okay, to just have a first-hand information, but do more than the credit reference bureau because it is not enough for you to be able to use to make an informed decision. It's just a guide.
It's true. In fact, I intentionally asked this question because I do believe that we are not really handling that aspect right. Because if an institution think that people can take advantage of the bureau in snatching their clients, so something that is supposed to rather help us to deal with some of these issues, they are not really populating it, and based on it, we cannot rely on it. Then I mean, it is really unacceptable. And as boss said, maybe we have to write through our association so that negotiation will be done with BOG, because it is really, it is not free. The SDS is not free. We buy it to assist us. So if we do buy this thing to enable us, and it is something that we cannot really depend upon it, because some institutions think that in a way others can take advantage of their clients, then I think it is really unfortunate. Thank you very much. Thank you.
Thank you. I think at this point, what we all also have to do is that once people contract loans from you, depending on whatever status you find them, you report to the bureaus so that we can all have concrete information to depend on. Other than that, if some are reporting, some are not reporting, when you go there, you face the same challenge.
Yes.
And again, I think with the coming in force of the Ghana card, I know some of these things will be sharpened a bit. It will improve, but it will not take overnight for us to see the improvement. So let's all work together to make sure we also contribute to this in enhancing it, to make sure we get our clients well served from those angles. But as Ziblim and Mauna has given us a lot to chew about, we all need to do our homework very well, do our part of the bargain, and make sure, especially those things that we can control from our angle. Once we work on it properly, the chances that the client good. So at this point, if there are no questions, we'll call it a day. Just as I told you, we'll be putting the link back to everybody who participated in today's activity, but we still have it on GAMFEN's website if you want to download and then listen to it again and again. The other webinars that will be coming on, we'll have one in 15th June. The link will be shared. The 15th June will be on the proactive strategies to prevent future non-performing loans. Then on 22nd, there will be another one on gender finance. It's a win-win situation. Gender finance, we are doing it because the first one, even though it was oversubscribed, we had a challenge with the Zoom link and a lot of people couldn't participate. So we want to bring it back to your doorstep. And then we'll do an in-person credit risk management, which I know a lot of people have registered already. So these are the events that will be occurring very soon. So at this point, we'll call it a day and then see you on our next webinar date. Thank you, Mauna and then Zibrim, for the wonderful work. And I believe our people have also gotten something to chew for the next few days. Thank you very much.
Okay, thank you too for organizing this session.
Right. Thank you so much.
Bye.
Okay, bye.